Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Nokia stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Nokia is a telecommunications, IT, and consumer electronics company. When the current CEO started last year, he admitted the company was struggling, and unless there were some major changes, the company may not survive. He spun off all the businesses with low margins that were capital intensive, and he reinvested that money in areas where the company has higher margins and a competitive advantage. He said to expect a flat or down 2021, a flat 2022, and then in 2023, we are going to be a strong and profitable machine like we once were. Nokia is the largest Finnish company. At its peak in 2000, it accounted for 4% of the country's GDP, 21% of total exports, and 70% of the Helsinki Stock Exchange market capital. At one time, this company was the largest provider of mobile phones in the world, but sold that part of the business to Microsoft in 2014. After the sale, Nokia began to focus more on its telecommunications infrastructure business and Internet of Things. Nokia returned to the mobile and smartphone market in 2016 through a licensing arrangement with HMD Global. It is also a major patent licensor for large mobile phone manufacturers. The company is headquartered in Finland and was founded in 1865. It trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Xetra, Vienna, Swiss, Italian Bourse, Prague, Euronext Paris, Nasdaq Stockholm, and Nasdaq Helsinki. Let's get started with the model. This is a large cap company, 32 billion market cap. They're trading at $5.68 a share, and they have 5.6 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. In 2018 and 19, they had negative free cash flow, but the new CEO is changing things, and they had 1.5 billion in 2020 and almost doubled that to 2.9 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative pretty much every year except 2019. But the reason it's negative in 2020 and the trailing 12 months was due to a reversal of a deferred tax asset. We'll talk more about that later. Revenue is the sales for the company, and that's pretty flat, around $25 to $26 billion a year. Their revenue was lower in 2020 and the trailing 12 months when compared to 2019. But look at how profitable they are. Look at all that free cash flow they bring in. So you can see the CEO is doing a great job getting rid of the low margin, inefficient businesses and focusing on the high margin businesses. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue from 2019 and 2020. So the country with the most revenue is the United States. Finland is 1.5 billion euros, which is a lot for a country with only 5.5 million people. All their financials are in euros. I converted them to US dollars on my Excel spreadsheet since we're looking at the ticker that trades in the US. Next is France at 1.4 billion, then India, China, and then all the other countries. 18 billion of their revenue is to communication service providers. These are companies like AT&T and Verizon. So this company provides 5G, 4G, and cloud technology. It also works with enterprises, big companies like Google and Microsoft. It generates 1.4 billion of revenue from licensing out its technology. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Cost of labor and cost of materials are part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that is improving each year. It's up to 8.9 billion in the trailing 12 months. And their revenue in the trailing 12 months is lower than 2018 and 19. So you can see they're becoming more efficient. So there's two ways to become profitable: increase your revenue or decrease your expenses, or do both. This chart is pretty impressive. They're improving their gross margins every single quarter. In Q1 2020, it was about 31%. Now it's up to about 37-38%. Below that is their operating expenses. It went from 8 billion down to 6.9 billion. Here's a breakdown of their operating expenses in 2020. Their largest, research and development, 4.1 billion. This is the cost to improve their current products or come up with new products. Then you have selling, general, and administrative, 2.9 billion, and then other, 323 million. And below that is their operating income. This is such an amazing improvement, 330 million up to 2 billion, with a similar amount of revenue. Below that is the interest they pay on their debt, which is 191 million, which is lower than 2018 and 19, but higher than 2020. And the bottom line of the income statement is their net income. They had a big negative in 2020 and the trailing 12 months, a small positive in 2019. The only reason it was negative in 2020 and the trailing 12 months was due to these large taxes. I would just focus on operating income when I look at the income statement. That's a better indicator of how the company's doing. Below operating income can really skew the numbers because of accounting changes. The company was carrying a deferred tax asset on their balance sheet. When you use a tax credit or a deferred tax asset, that lowers your taxable income, which means you pay less taxes. So even though it looks like they had a big loss, this was a non-cash item. For instance, if you made $50,000 at your job and you had a $50,000 tax credit, say you put solar panels on your home and you were given a $50,000 tax credit, on your taxes it looks like you made nothing because you had $50,000 of income minus the $50,000 tax credit. So your income is zero. So you pay no taxes, but you still made the same salary. You just don't pay any taxes. So you have more cash flow coming in that year. A way to convert net income into cash terms is to look at the statement of cash flows. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So operating cash flow is net income converted to cash. Even though they reported that big loss, they generated a lot more cash flow in 2020 and the trailing 12 months when compared to 18 and 19. They also spend a good amount of capex each year, 500 million to 700 million euros a year. Operating cash flow minus capex gives you your free cash flow. And that's improved a lot from negative in 2018 and 19 to a big positive in 2020 and the trailing 12 months. This is their trailing 12-month free cash flow by quarter. So you can see it was negative every single time in 2019. And then it turned positive in 2020 and it keeps improving. So you can see the new CEO is doing an amazing job. It looks like they add debt every year. In 2018 they added 139 million. They paid down 31 million. So they added about 138 million in 2018. They only added 50 million in 2019, 1.1 billion in 2020, but they did pay down 700 million in trailing 12 months. Here's a breakdown of their operating cash flow section from their annual report. And the way you calculate operating cash flow, you start with their net loss, negative 2.5 billion. Then you have to add or subtract the non-cash items on the income statement. So we have to add back 5.3 billion. Then we have to adjust for changes in working capital. Even though they reported an accounting loss of 2.5 billion, they actually generated 1.8 billion of cash flow. The main reason was the addition of 5.3 billion of non-cash items on the income statement. This 5.3 billion brought down their net income, but it's all non-cash items. Every year they have lots of depreciation because they have a lot of fixed assets on their balance sheet, so they pass through 1.1 billion of depreciation expenses. But the big non-cash item was the income tax expense. The income taxes on the income statement are not the actual taxes the company pays or receives. Because the way a company calculates taxes and the way the government calculates taxes is different. So they have to add back that $3.3 billion of taxes since it was a non-cash item. It does bring down their net income, so they do pay lower taxes. The lower your net income, the less taxes you pay. Remember in that example I gave you earlier, when you made $50,000 but you got a $50,000 tax credit, so your net income was zero? Here's the cash flow from investing section. The top part is CapEx, their investment in property, plant, and equipment. That was 479 million. They spent 104 million in the acquisition of some businesses. They invested 1.2 billion euros. This is probably a short-term investment, so they don't have to sit on cash and they can earn a little more interest on the money in their bank account. This is their cash flow from financing section. They added 1.6 billion of debt. They repaid 246 million of debt. They paid out 148 million to preferred shareholders. This has to be dividends to preferred shareholders because in the past they stopped paying dividends to their common shareholders. Let's look at the capital structure. 19 billion of equity, 7 billion of debt. They're 73% equity, 27% debt. Their net debt is negative, so they could pay off all the debt with the cash in that balance sheet and still have $4.1 billion of cash left over. And their WACC is 7%. I gave them the middle WACC on Finbox, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $55 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $50 billion. We divide that by 5.6 billion shares. And we get a calculated stock price of $8.87. They're trading at $5.68, so they're trading at a 36% discount. It's a buy according to the model. The average analyst projects their revenue to grow 2.6%. To calculate their future revenue estimates, I grew at 2.6% for the next 4 years. To calculate their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I just used 2020 and the trailing 12 months, since I think that's a better indicator of the future, because they were a lot more inefficient in the past, and with the new CEO, they're a lot more profitable. So if you sum up these two free cash flow numbers and divide that by the sum of these two revenue numbers, that's 8.5%. So they convert 8.5% of their revenue to free cash flow. So I multiplied their future revenue estimates by 8.5%. That's how I got their future free cash flows. And they're all below their trailing 12-month number. So I think this is a target they can hit. So it seems like the stock is really undervalued. Simply, Wall Street values the company at $6.53. They're saying it's 13% undervalued. Two analysts price this stock. The average price target is $7. This is where the stock has been trading the last 5 years. So you can see it was fairly steady. It did drop a lot at a couple of points, especially during the March 2020 crash. And this is just nuts. Look at all this trading activity. This stock was part of the whole meme craze with AMC and GME. A ton of buying activity on this day. The Reddit community was trying to apply a short squeeze. But you can see the stock has done pretty well since this date. It's hovering around $6. It was around $4 at this point. The company has not paid any dividends last year or this year. I think there's a decent chance they will start paying a dividend next year. They have a low beta, 0.54, so the stock moves half the market. It's not volatile. It's gone up 50% in the past 52 weeks, while the S&P is up 30%. The 52-week low was $4. The high was $10. And the stock is trading between its 50-day and 200-day moving average. This is a really popular stock. Over 18 million shares are traded each day. Of the 5.6 billion shares outstanding, 4.6 billion are on float, 8% are held by institutions, and under 1% of the shares are shorted. They have a lot of employees, 92,000. They have been trimming their staff. That's why their margins are improving. They've gotten rid of the inefficient divisions and are just focusing on the more efficient ones. If you put $10,000 into this company 10 years ago, you'd be at $12,000 today. That's only 2% annual return. Look at all these crazy movements. You would have been down a lot, then up a lot, then down, up, down, up. It would have been a roller coaster ride. The biggest shareholder is Solidium. This is a state-owned Finnish investment company. Then Vanguard, BlackRock, Norges Bank, and Artisan Partners. Let's look at their financial ratios. We can't look at the PE because they have negative net income. But if we strip out that deferred tax asset, their PE would be around 15. They have a price to sales of 1.2, which is really good, much better than a market median average, and a really good price to book of 1.7. A solid ROIC of 13%. They can cover their interest payments 8.5 times. A negative ROE since they have negative net income. A good current ratio of 1.6 and a good quick ratio of 1.4. In the United States, assets are listed from most liquid to least liquid. In Finland, they do the opposite. It's least liquid to most liquid. The definition of liquid is cash. That's why cash is the most liquid. They have over 10 billion euros of cash and short-term investments, 4.5 billion of accounts receivables, and 2.5 billion of inventory. So the company is in really good shape financially. They generated 2.9 billion of free cash flow in the trailing 12 months, over 8 billion of working capital. Working capital is current assets minus current liabilities. They have over $11 billion of funding. That's why I'm pretty confident they're going to start paying a dividend next year because they're bringing in lots of cash flow. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 10 companies in the same industry as Nokia. And if Nokia has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at their PE, but if we stripped out the deferred tax asset, they would be better than average. They're doing better in price to sales and price to book. They have a good current ratio. Their ROE is negative, which is better than average because the average is negative 18%. They're doing better in debt than the average company, and they're a pretty big company, 32 billion market cap, but the average is 39 billion because Cisco is so big. So to summarize, I have them trading at a 36% discount, but mark my words, this will be a $100 billion market cap company in the next 2 to 3 years. They're slowly building their foundation back to where it was, and then they're going to take off. I know I've been saying this every quarter, but it just seems like they're doing better and better. The numbers don't lie. Look at that free cash flow, $3 billion. I rank their free cash flow as 9 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.